What happens with your property losses when you own property in your own name? Hi, I'm Kimberly Shapcott, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. Depending on what's happening in your property business, there are times where we are going to have losses. But what happens with those losses and how does it fit together? Well, let's have a look at our two key losses for an individual to show exactly what happens with your losses when you make them. So the first set of losses we need to look at is going to be when you make losses in your property business. So it may be you've had some voids during the year, you've had some repairs and you've made a loss in that period. And that is carried forward to the next period and set against future rental profits. But let's have a look at a few quirky points so that you know exactly how that fits together with an example. The other losses we're going to have a look at, or costs that we are going to just be clear on, is our residential finance costs. Because if you don't fully use them in a year, then potentially they will get carried forward to use in a future year. So let's have a look in detail at that one as well. Let's jump into some examples to see how those finance costs work and how our losses get carried forward. Let's dive into our example. So we're going to go on a little bit of a story today and tell you how it tracks through from one tax year to the next tax year with some losses. So we're going to start off with a salary of $15,000 for our fictitious Joe Bloggs. We are going to have rents of $15,000 as well. We were also going to have some mortgage interest because they have got some bits in there, and they have had a very, very bad year for repairs. They maybe had a bad tenant in, and on that basis, their repairs and expenses bills for the year are $20,000 compared to their income of $15,000. So they've had a really bad year. So now if we look at the tax position, we can see that their gross income is going to incorporate our $15,000 salary. But for our rental profits, we have got to take our $15,000 and our $20,000 to give us minus $5,000. Now, for tax purposes, this means that our tax calculation is going to take our income of $15,000, which will be able to take off our personal allowance of $12,570 to give us taxable income at this point of $2,430, which at 20%, because that is all in our basic rate band, is going to give us a tax bill of £486, which, because it's PAYE, we are going to have tax paid, and hopefully your PAYE coding notice is correct. So you've already actually paid all of this. So for this period, we have got no tax to pay, and we have got some other things to be aware of. So our other things to be aware of is we have rental losses of $5,000, which we are going to carry forward. That is this figure. We also have mortgage interest that we have not used. So this is our residential finance charges. And these come to the total, as we can see up here, of again $5,000 to keep us in nice round numbers. So in our first year, if we treat this as say 2022, 2023, we have some information that we're going to carry forward to our next year's tax calculation, and there's no additional tax to pay. So let's now jump forward to the next tax year and have a look at what is going to happen from this point of view. So we're now jump forward into our 2023-24, and this year we're going to work on the basis we've got no salary, because the idea was to go full-time into property. They've given it a go and they have gone full into property. This year we still have our rents of $15,000, Our mortgage interest has remained relatively similar, so that is 5,000. Maybe we're on products which keep it the same. And this year our repairs bill is reasonable and it is not excessive. So this year we only have 2,000. Which now means when we look at our rental profits, because we've got no other income to report at this point, we now will take our 15,000, take off our 2,000 to give us 13,000 profits. Now, before we get into our tax calculation, what we need to do is start looking at a few things. So for our tax calculation, we will take off first we will include our rental profits as our income. But before we get onto our personal allowance, we have to match our rental losses against our first lot of rental profits. So we will take off our 5,000 that we brought forward from last year to give us actually 8,000 of taxable income, which now we will take off our personal allowance, which is actually only going to be 8,000 out of the 12,570 because we've only got 8,000 of taxable income. Obviously, this now means, hopefully, as you can see, that we've actually lost 4,570 of taxable income that we could have used. Now, the one positive thing that we can say in this regard is our residential finance charges only come into play when we have tax to pay. So with our mortgage interest, we don't need to do our normal calculation of looking at what is the lower of the finance costs, the property profits, or the adjusted total profits, because we can't actually do any sort of residential finance charge adjustment because there is no tax to put a tax credit against, which therefore means for this year there is no tax to pay. Our residential finance charges, we've got 5,000 brought forward. We've got the current year of 5,000. So now we've got 10,000 we have not used, which means our carry forward figure is going to be 10,000. In terms of our rent losses, we've used them. So there are no rental losses available to carry forward. So that gives hopefully a picture of where our rental losses have been used and leaves us with what can we do with our residential finance charges. So let's jump forward yet another year, and we are going to look at potentially 2024-25 if we're going in recent tax years. And we're now going to say the property thing, it worked, but now they've got a salary of 45,000 from whatever other income sources. They've still got their rents because these 15,000 is a nice consistent amount. Maybe they should have increased the rent, but let's just keep the numbers simple. Their mortgage interest is going to be staying the same because they're on a fixed rate deal. So it's going to be around 5,000. And our repairs and expenses side of thing are going to be 2,000 because it's relatively similar to previous year. So now we can look at the tax position, and our tax position is going to be, we have got income from employment of 45,000. We've got rental profits of our 15, take off our 2, so our 13,000, which gives us total income of 58,000. So now when we come to our tax calculation, we're going to take off our personal allowance of 12,570. We are going to be taxed at the basic rate of 20%. 20% for 3,700 at 20% equals 7,540. And then we've got some at the higher rate of 40%, which is 7,730 at 40%, which is 3,092, which gives us total tax payable of 10,632. However, we have got some residential finance charges that now we have some profits, now we have some tax paid, we can actually look at using. So we now need to look at the lower of three numbers, which is our finance costs, which is going to include our brought forward figures, our property profits, and our adjusted tax profits. So our finance costs are going to be at 5,000 in the current year, and we've also got those 10,000 brought forward. So that means this figure is actually going to be 15,000 because we've not used some in the past. We also have our property profits, which are going to be from over here at 13,000. And then our adjusted tax profits are at 58,000 that we've got in the middle. So we're now going to select which is our lower one, which, as you can hopefully tell, is our 13,000. So we now have our 13,000 at 20%, which comes to 2,600 that we are taking off the tax charge. This now gives us a figure of £8,032 tax payable. However, because some of it has come in through PAYE, so our tax paid estimated based on my calculations is going to be 6,486 based on the salary. So from an actual payment point of view, you've actually only got about 1,546 to actually pay. The other thing that we need to know is we brought forward 15,000 residential finance charges, costs that we had banked already. We have only used 15,000, so brought forward figure is 10, current year is 5, our used figure is 13, which means our carry forward figure is going to be 2,000, which can be used potentially next year depending what has happened. As you can see with these calculations, there is some of the numbers that are more flexible than the others, and hopefully this puts what I noted in the earlier part of the video into more practical sense, where you may find if you get the rental losses and they have to be used against the earliest rental profits, you may find you lose out in our year 2 position where you lost some of your personal allowance. Also, the finance charge costs are actually maybe a little more flexible because you're not going to use them all until you do actually pay some tax. However, it is limited what you can use them against. You can't use them against all of the income. So the most that you can get out of having to pay is the 20% of 13,000, which is the rental profits. In the final year's example, we've obviously taken it into a higher rate tax position. So there is still some tax to pay. However, if they were still a basic rate taxpayer, then there would be no additional tax to pay on the rental profits. And if their income had been within the basic rate band, they'd have paid all their tax, hopefully on their employment job. So potentially on the tax return, there'd have been no actual tax to pay, unless there was income from other sources like dividends or interest or some of that sort of thing. So as you can see, there is a few variations here that we need to be aware of, but hopefully this is giving you a more practical application of some of the concepts about property losses that we have been discussing today. As you can see, rental losses can be slightly problematic because they do have to be set off against the first lot of rental profits that you make. So if you're not making enough rental income to be paying tax, you may arguably lose those losses based on how it fits together. Obviously, the finance costs, they get carried forward and they can be used at an appropriate time when you are paying tax. So they're a bit more advantageous at this point compared to the normal rental losses at this point. Hopefully today you've discovered what happens with your property losses, for your losses and for your finance cost losses that are unused as well. If you have any questions, then please leave a comment. Please like the video and do subscribe to the channel. And let's make tax less taxing.